In this video, we're going to talk about two pretty powerful indicators that a lot of people ignore, and that's going to be the Keltner Channel and the Chaikin Money Flow, or the CMF. And if you're just tired of relying on the same old indicators that everyone else is using, the RSI, the crossovers, MACD signals, well, this is going to be for you. But let's start with the Keltner. And this is my favorite trading indicator. And it does help you spot trends. It can help you identify reversals, show volatility, can even help time your entries and your exits with some greater precision. So the Keltner Channel, 3 lines. The middle line is a 20-period EMA. That's a standard setting. The upper band is the EMA plus 2 times the ATR, the average true range, over 10 periods. And the lower band is the EMA minus 2 times the ATR. So the Keltner Channel is going to show you not just the trend of the price with the EMA, but the channel angles. And it's also how much the price is moving up and down using the ATR. So the bands are going to automatically expand when the market gets more volatile and contract when things calm down. When that happens, when a market gets more volatile, the average true range of price gets bigger. When it calms down, the ATR of price gets smaller. This is why the bands will contract and expand. So why does this matter? Well, if the price shoots out the bands, it can signal a strong move, can signal a breakout, and that's going to help you catch a trend a little bit earlier. It can help you time your entry and your exit. So the bands can act as a dynamic zone of support and resistance, showing when the price might be stretched too far and could reverse. And because the bands do adjust to the market volatility, the indicator is going to stay relevant whether things are calm or they're volatile. So it's going to make your read on the market a lot more reliable. So how can we use it? We're just going to touch on it here. If the price is above the middle line and it's hugging or breaking above the upper band, well, the market's strong. It's trending up. If price is below the middle line and touching or breaking the lower band, we're looking at a downward trend. And when price pulls back from upper or lower bands towards the middle line, it can be a reversal or a place to look for entries in the trend direction. So for example, the stock here, it's in a steady uptrend. Price pulls back from the upper band to the middle line area. If it finds support and starts to bounce, this could be a great place to enter a long trade with a stop just below the lower band or under your entry candle. Now the CMF, the Chaikin Money Flow. So this measures buying and selling pressure over a 20 or a 21 period window by combining price and volume. Now, the Chaikin Money Flow, it does technically oscillate between plus and minus 1, but in real-world trading, you're going to see that most values are a lot closer to 0. Typically fluctuates between plus or minus 0.25 or 0.4. There's a bigger area there. This is important because it does mean that even relatively modest readings can be pretty significant. So how do we use this? Well, if it's above 0.05, this is generally interpreted as buying pressure. The bulls are in control. And since most readings are near 0, a push above 0.05, I want to take notice of. Below negative 0.05, we're looking at selling pressure. The bears are dominant. Crossing 0. So when it crosses above 0, it often signals a shift towards bullish momentum. Drops below 0, it's a warning of increasing bearish conditions. And we can look for extremes. Readings above 0.4 or below minus 0.4, they're pretty rare. And it can usually indicate unusually strong pressure and potentially unsustainable buying or selling pressure. So let's look for some extremes. So if we're looking at readings above or below plus or minus 0.3, 0.4, that can indicate unusually strong buying and selling pressure, and it may be unsustainable, and we may be looking at a reversal. We can also look for divergence. So we want to look for that between price and the CMF. So for example, price is making new highs, but the CMF does not. It can signal that the uptrend is losing steam and could soon reverse. So let's put these together into a trading strategy that you can look at on your charts and you can test out. So for a bullish setup, we're going to look for trend. So the overall trend is up, right? Price is above the 20-period EMA, or it's making higher highs and higher lows. We're going to look for price to pull back to the middle line, the 20 EMA, or even the lower Keltner channel. And then we're going to look for the CMF confirmation. Is it positive? Ideally above plus 0.05, indicating buying pressure. We want to look for a bullish reversal, a candlestick pattern, such as a hammer, a bullish engulfing, or any other reversal type. And we want to see that forming near the middle or the lower Keltner channel. Entry trigger, just enter a long trade when the next candle closes above the high of your reversal candle. Stops, just place it below the lower Keltner band, the middle band, or just below the low of the setup candle, right? So you want to choose that level that best fits your risk tolerance and the chart structure you're looking at. Profit targets, this all depends on where your setup is. First, look at the upper channel as your first target. Your second target, if momentum is strong, right, just add the width of the channel to the upper band. Bearish, flip it around. Confirm the overall trend is down, prices below the 20-period EMA, or making lower highs and lower lows. Wait for price to rally up to the upper band or the 20 EMA. Make sure that CMF is negative, ideally below minus 0.05, indicating selling pressure. So we want to look for a bearish reversal candlestick pattern, a shooting star, a bearish engulfing, or any other reversal type, and make sure this is forming near the upper band or the 20 EMA. Enter a short trade when the next candle closes below the low of your signal. Stop, just like the other one, place it above the upper channel or the high of the setup candle. So our profit targets, we can look at the lower Keltner channel or use a target by subtracting the channel width from the lower band. And we always want to make sure that we confirm our trades with the overall market context and avoid trading against those stronger, higher time frame trends. Now, there's some mistakes that we want to avoid. We don't want to just take a trade because the price touches the EMA or a band. We want to look for the confirmation with the CMF. We want to look for a clear reversal signal. We also don't want to ignore the broader trend. So these indicators do work best when we use it in the direction of the major trend. And we certainly want to avoid using too much leverage. And we certainly want to stick to our risk per trade when it comes to risk management. And the final tips that I would say, use a higher time frame, like the 4-hour, the daily, the weekly. You can use that to determine trend direction and use the 1-hour chart for trade entries in that direction. Watch for the CMF divergence for early warnings of trend changes. And you can adjust the Keltner Channel's ATR multiplier if you find it too tight or too loose for your trading style. For example, Bitcoin, you may want a wider multiplier. So try these out. I want you to just paper trade your setups and just see how they work out for you. If you have questions or you want to share your results, just leave a comment below. And if you found it helpful, hit subscribe. We'll talk to you soon.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.